When markets roar and your feed says buy now, the smartest move is often to do nothing. Warren Buffett's edge isn't secret data or a faster screen, it's patience and temperament. Today, we'll build a simple playbook, 8 lines from Buffett that can change how you work, invest, and decide. The stock market is a device for transferring money from the impatient to the patient. During the financial crisis of 2008, many investors panicked and sold stocks after they plunged, but Buffett did the opposite. While others were frantic, he held on and even bought more shares of solid companies at fire sale prices. Over the next few years, markets recovered. Those who stayed patient saw their investments rebound and grow, whereas the impatient sellers had locked in their losses. Time and again, quick, nervous traders end up handing profits to the calm, long-term investors who wait. In short, the tortoise beats the hare in the stock market. Money finds its way to those who can be patient. Successful investing takes time, discipline, and patience. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. Think of making coffee. It takes 4 minutes for a French press to brew. If you try to speed things up by using 4 presses at once and pressing after 1 minute, you just end up with 4 cups of terrible coffee. Some outcomes simply can't be rushed. Investing works the same way. You might be the smartest investor in the world or work 24/7 researching stocks, but you still won't turn $1 into $1,000 overnight without insane luck or risk. Buffett's own fortune was built gradually, over decades, not in a single lucky year. He bought good businesses and then patiently let time and compounding do their magic. No amount of talent or hustle could replace the need for that patience, just like no parent can skip the months of waiting for a baby to arrive. If you are not willing to own a stock for 10 years, do not even think about owning it for 10 minutes. Back in the late 1980s, Warren Buffett invested heavily in Coca-Cola. He didn't plan to flip it for a quick profit. In fact, he went in with the intention of holding Coca-Cola for years, if not decades. Through market crashes, recessions, and all sorts of headlines, he never lost confidence in Coke's enduring brand and its ability to sell drinks year after year. Sure enough, a decade later, his investment was doing great, and many decades later, he's still holding those shares. Coca-Cola became one of Berkshire Hathaway's most famous success stories precisely because Buffett gave it the time to grow and didn't jump ship at the first sign of trouble. The lesson here is that you should buy into a business only if you'd be happy owning it for the long haul. If the idea of holding a stock for years makes you anxious, then it's probably not the right stock for you. True wealth in the stock market tends to come from slow, steady compounding. Buffett believes in finding great companies and then sticking with them, allowing the investment to mature. If you can't envision being in it 10 years from now, it might be better to pass on it altogether. Only buy something you'd be perfectly happy to hold if the market shut down for 10 years. In 1972, Buffett acquired a little West Coast chocolate company called See's Candies. Once he bought See's, there was no public stock price to obsess over. He owned it outright, so he couldn't wake up each morning and see it on a ticker, and that was just fine. Year after year, See's kept selling its famous box chocolates and generating steady profits, all of which flowed into Berkshire Hathaway's coffers. Buffett has held on to See's for decades now, and its value has grown tremendously over that time. He often jokes that if the stock market closed for 10 years, it wouldn't bother him because he'd still be happy owning companies like See's that just quietly make money in the background. This quote is about having that level of confidence in what you buy. Picture owning a small rental property or a farm. You wouldn't check every day to see what someone would pay for the farm. You care that the crops are growing or the rent is coming in. Buffett approaches stocks the same way. He buys shares of a company with the idea that even if he couldn't sell them for a long while, the business would keep on earning money and building value. In other words, buy businesses so solid that you'd be comfortable holding them and letting them do their thing without needing to constantly trade in and out. The stock market is a no-called strike game. You don't have to swing at everything. You can wait for your pitch. Buffett likes to borrow a metaphor from baseball to explain his style of investing. In baseball, if you just stand there and don't swing, the umpire will eventually call you out on strikes. But in the stock market, there are no umpires calling strikes. You can let dozens of opportunities go by without swinging, and it costs you nothing. Buffett often sits with cash, watching and waiting until an investment pitch comes along that is right in his sweet spot. He's in no rush. There's no one forcing him to take a swing at a mediocre deal. A great example of this patience was during the late 1990s dot-com boom. Everyone else seemed to be swinging at every internet stock that came their way, but Buffett didn't understand those new businesses well and didn't see good values, so he mostly kept his bat on his shoulder. Plenty of commentators thought he'd struck out by not joining the tech frenzy, but when the dot-com bubble collapsed, Buffett was vindicated for avoiding those wild swings. Then, when a fat pitch did come, for instance, in 2008 when solid companies were suddenly available at bargain prices, he was ready and swung hard, investing billions in deals that paid off. The point is that an investor doesn't get extra points for effort or for swinging at more pitches. You win by waiting for the perfect pitch and then making a big, decisive move. Someone's sitting in the shade today because someone planted a tree a long time ago. Imagine a village where, many years ago, a farmer planted a small oak sapling on a barren patch of land. At first, it was just a tiny tree and didn't seem like much, but the farmer tended to it. Season after season, decades later, that oak tree grew tall and wide, and now the whole village enjoys its cool shade on hot days. They all benefit from the foresight and patience of that one person who planted the seed long ago. Buffett uses this image to highlight the importance of long-term thinking. In the world of investing, the shade could be a comfortable retirement or a college fund or a thriving business, and the tree is the investment or effort made years prior. Buffett himself started investing as a kid, planting financial seeds early. For example, he bought his first stocks as an 11-year-old and kept learning and investing through his youth. Most of his enormous wealth came much later in life, essentially as the shade from trees he planted when he was younger. The takeaway: the earlier and more patiently you invest or work toward any goal, the bigger the reward down the road. Even if it takes a long time to see results, you'll be very glad you started when you did. The most important quality for an investor is temperament, not intellect. In the early 1960s, American Express was hit by a shocking scandal known as the salad oil scandal. Suddenly, everyone on Wall Street thought American Express might go bust, and its stock price plummeted. A lot of very smart people, well-educated analysts and seasoned investors, completely lost their cool and rushed to sell the stock, fearing the worst. Buffett, who was a young, relatively unknown investor at the time, looked into the facts calmly. He noticed that despite the scandal, people were still dining in restaurants using their American Express cards, and travelers were still buying American Express travelers' checks. The core business was basically sound. The company had taken a big hit, but it wasn't the end of the world. So while others were freaking out, Buffett started buying American Express stock on the cheap, showing almost nerves of steel. That bet turned out to be a huge win for him. But what's important is why it was a win. It's not that Buffett was the only one smart enough to see value in American Express. Plenty of those panicky investors were extremely intelligent. The difference was temperament. Buffett didn't let fear overtake him, and he didn't follow the crowd. He trusted his own analysis and stayed emotionally steady. This quote drives home that investing well isn't about being a genius or doing complex math. It's mostly about keeping your head on straight. The investor who can remain calm, rational, and disciplined when everyone else is losing their composure is the one who will come out ahead in the long run. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. Buffett has a contrarian streak, and he sums it up in this famous guidance. A classic example was during the late 1990s tech stock mania. At that time, everyone and their neighbor was greedy for dot-com stocks. Investors who normally might know better got swept up in the euphoria, thinking prices would only go higher. Buffett saw that many of these businesses didn't have real earnings or solid fundamentals, so he chose to sit it out. In other words, he became fearful when the market around him was ridiculously greedy. People thought he was missing out, but when the bubble popped, his caution proved wise. He had preserved his capital while many others lost a lot. Fast forward to 2008, when the situation was reversed. A banking and housing crisis hit, and suddenly fear was everywhere. The stock market plunged, and even great companies saw their shares fall to fire sale prices, as investors were afraid these businesses might not survive. Buffett had been through financial storms before, and this time he switched to greedy mode when everyone else was scared. He made big investments in stalwart companies like blue-chip banks and industries when their prices were beaten down and nobody else dared to step up. It wasn't easy, it never is, because in the moment everyone was saying the world might end, but Buffett's moves during those dark times ended up making Berkshire Hathaway and its shareholders a lot of money when the panic subsided and those companies recovered. This quote is all about zigging when everyone else is zagging. It captures an essential part of Buffett's temperament. He controls his emotions and even uses the extreme emotions of others to his advantage. When others are greedy and complacent, he gets suspicious because that's when bubbles form. And when others are cowering in fear, he sees opportunity because that's when bargains appear. It takes a cool head and a lot of patience to do this. You might wait years for either greed or fear to grip the market, but Buffett has shown that this disciplined, contrarian approach can lead to outstanding results.